High-yield savings accounts are earning 5% APY right now. That's 13 times more than traditional savings. In this video, we're comparing the 5 best ways to invest $10,000 over the next 12 to 18 months, from zero-risk treasury bills to higher-return peer-to-peer lending. By the end, you'll know exactly which option fits your timeline and risk tolerance. When you're investing for just 12 to 18 months, your goal shifts. You're not trying to beat the market, you're trying to keep your money safe while earning real returns. The good news? The interest rate environment is working in your favor right now. According to the Federal Reserve, the federal funds rate is holding steady at 3.50% to 3.75% through 2026. That means banks are keeping rates attractive on savings and fixed income products. Your main options are high-yield savings accounts earning up to 5% APY, certificates of deposit at 4.20% APY, money market accounts at 4% APY, and treasury bills, all backed by the government or FDIC insurance. These vehicles prioritize liquidity and predictable growth, which is exactly what you need when your timeline is short. Let's put this in perspective. A traditional savings account at a major bank earns about 0.38% APY on average. That means your $10,000 would generate just $38 per year. A high-yield savings account? Up to 5% APY as of April 2026, according to Fortune. Same $10,000, but you're earning $500 annually instead. That's more than 13 times higher. Why the massive difference? High-yield savings accounts are offered through online-only banks with lower overhead costs. They pass those savings to you as higher interest rates. And here's the key benefit for your timeline. Your money stays liquid. You can access it anytime without penalties, unlike CDs. That flexibility matters when you're planning for the next 12 to 18 months. Certificates of deposit work differently. You lock up your money for a fixed term in exchange for a guaranteed rate. As of April 2026, the best CD rates are hitting 4.20% APY, with the strongest rates on shorter-term CDs, ranging from 5 months to 12 months. That 12-month option lines up perfectly with your timeline. If you withdraw early, you'll pay a penalty, typically 3 to 6 months of interest earnings. So CDs are ideal if you can commit your $10,000 for the full term. You get a guaranteed return with zero market risk, and you know exactly how much you'll earn. The trade-off is simple. You give up liquidity to lock in that rate. For investors who know they won't need this money, that's a smart move. Money market accounts sit between high-yield savings and CDs. They offer rates around 4% APY as of April 2026, according to NerdWallet. That's 6 times better than traditional savings. What makes them different? You get some of the perks of a checking account. You can write checks and use a debit card while earning competitive interest. That flexibility costs you a bit compared to pure savings accounts, but not much. A heads up though, money market rates have actually declined. Back in 2024, they were offering 5% or higher. Now we're at 4%. Still solid for a 12 to 18-month window, but worth knowing if you're comparing options. If safety is your absolute priority, treasury bills are worth considering. Treasury bills are short-term government debt instruments sold in increments of $1,000. You buy them at a discount and receive the full face value at maturity. For example, you might pay $9,900 for a $10,000 T-bill that matures in 1 year. That $100 difference is your profit. Here's the key. Treasury bills are backed by the full faith and credit of the U.S. government. You're not subject to FDIC insurance limits. Your entire investment is guaranteed. There's no market risk whatsoever. For investors who want the absolute safest investment, T-bills beat everything else. You sacrifice some return compared to high-yield savings, but you get unmatched security. Now, what if you want higher returns? Peer-to-peer lending platforms connect borrowers with individual lenders like you. You invest small amounts across multiple borrowers and earn interest as they repay. The potential is real. Expected returns of 6 to 12% for short-term investments, according to our sources. That substantially exceeds what you'll earn from savings accounts or CDs. But here's the catch. Higher returns come with higher risk. If borrowers default, you lose money. There's also platform risk. What if the company itself fails? And liquidity risk. your money may be tied up longer than you expected. For your $10,000 over 12 to 18 months, peer-to-peer lending could work if you can tolerate that risk. But it's not the safe play that Treasury bills or CDs offer. You now have 5 solid options for your $10,000. High-yield savings for flexibility, CDs for guarantees, Treasury bills for safety, or peer-to-peer lending if you want to chase higher returns. Read the full article at wealthwire.com to compare detailed rates, pros and cons, and specific platforms for each option. And if grounded personal finance advice helps you, please subscribe and hit the notification bell. We drop videos every week breaking down real money decisions. Thanks for watching.